I guess the big question at the moment is we've seen a fantastic run for the banks since 2009 now. We've seen Commonwealth Bank up a massive 150%. And, you know, earnings haven't gone up by 115%. So is this sustainable? Russell, when you look at this, what do you think?
Yeah, I had a good look at the results today, and I understand why the market took the ANZ share price up 5.5%. I think it was up 6% at the close. I didn't look at it at the close, but I looked at the top line growth in the business, and there literally was none. I'm looking at my notes here. Net interest income which is their growth in their loan book, the income off their loan book was up 2%. Non-interest income, so that's funds management, insurance broking, and the like, was down 5%. So net, their total revenue was basically flat after you strip out Visa. And all the growth they obviously reported a growth in profit, but all that growth came from cost out. So it came out in terms of expenses, their cost to income ratio fell, and also it came out in terms of bad debt. So they're experiencing a lot of homeowners, such and so forth, are finding it easier with lower interest rates to repay their home loans. So that boosted the bottom line. But those efficiencies also come at a cost. I'm seeing 8% decline in expenses here, and the human cost of that. So there have obviously been people that have lost their jobs as the bank isn't growing. These people can't justify their positions within the bank. So
the banks have become leaner, meaner, and that's really where the profit growth has come from. We've seen costs being cut by 8%. Based on what you've seen in the results today, would you be buying the banks? Because we're seeing phenomenal share price performances.
Well, the share price performance is up because everyone is chasing yields in a low interest rate environment, with the RBA setting rates at 3, and the market calling because the inflation is trending lower, GDP is trending lower, with mining investment potentially coming off quite significantly in future periods. Everyone's calling for further rate cuts. So the announcement, and ANZ, funnily enough, put this announcement at the top of their report, was an increase in the payout ratio, so an increase in the dividend from 66 cents to 73 cents. 73 cents, which was even more than analysts had expected. So I suspect that was a large reason for the rise in the share price, as opposed to a business that's actually growing.
Mark, welcome. What's your question for our panel tonight?
Evening, Julia. Thanks for taking my call. Yeah, I'm interested. I've got Australand and Asciano. I've had them for a while, and I'm about even with them. Just wondering what the panel thought of those guys, whether they're worth holding on to or getting out of them into something, maybe gold, or what do they think?
Sure. So good question regarding Australand, which is in the property space, and Asciano, which of course looks at freight for bulks and grains, especially in the coal sector. So an interesting question there with Asciano, and of course lots happening in terms of Australand as well. So Russell, looking at Australand first, and what's your view on this particular stock? I mean, there's been talk of opening up the data room, potential takeover. We haven't seen too much coming through there for this particular stuff?
It's not one, unfortunately, that I can offer a lot of value. I rarely step into the REIT area. If I want an investment in property, I'll generally go out and purchase it myself. Look, these investments are great when you can buy them at a discount to NTA. So back 2 or 3 years ago, when real estate investment trusts had the NTA of $1 and they're trading for 50 or 60 cents, you're effectively buying property at a 40% discount to what they were worth on market. So look, I'm not sure about the NTA of Australand at the moment, but I'd have a look at that in terms of my valuation proxy. If the share price is matching or exceeding the NTA of the business, that would be a good case to say if it's fair value or expensive, but I can't make that call.
Okay, I've got Brett on the line from Sydney. Brett, welcome. What's your question tonight? Hi, Brett. Do we have you there?
Good. Yes, yeah.
Hi, how you doing?
Yeah, good, thanks. Sorry about that. Mine's regarding Data 3. Broke below $1.20 today, and it's yielding about 6%, fully franked.
Yeah.
I'm just wondering, do the boys think it's a good buy at this price, or do they feel like the outlook for it could be flattish?
It is a very tough space at the moment, especially with the uncertainty around the election and all the rumours we're hearing throughout all levels of government. There's been a significant cutback in spending, and a lot of these businesses, your Oaktons, your SMXs, really rely on that government spending, that big ticket spending. I mean, they're effectively body shops government needs a piece of infrastructure built for them, these guys will package up a number of very skilled people and build the infrastructure and the IT systems that they need. But there's just been a complete void of that recently, and what I'm hearing on the ground, it's absolute carnage out there for these companies. So look, we don't have any IT companies in the moment in the Montgomery Private Fund, but DTL operates in a bit of a different space. It operates predominantly from memory in the licensing space. So and it does have consulting services, and it does have a recruitment arm as well. But from memory, the larger part of its revenues came from licensing, which was more recurring. It basically tenders for big contracts for government, for police force, for hospitals, for education, such and so forth. And it provides all the licenses, all the software for computer systems. So it's very low margin work, but it's quite stable work. And John Grant, who is the CEO of this business, has really carved out a very, very good niche in that part of the market. But saying that, no business is immune in a downturn in IT spending, and I just think there's just some significant headwinds for the whole sector, so we're just not there at the moment.
Okay, we have Peter on the line from Melbourne. Peter, welcome. What's your question tonight?
Good evening, Julia. Thanks for having me on the program. I own CSL shares, and I'm just wondering what the panel thinks about their future outlook. And I'm also interested in what they think about the sort of fairly consistent share buyback that goes on. What might be the implications of that?
Peter, this is a fantastic business, and it's actually one of our largest holdings in the Montgomery Private Fund. So if you've held it for a long time, my best advice, and it's not really advice, of course, but my advice is just to continue to hold this business. This is a business for the last 10 years has increased its earnings per share 25% per annum on a compound basis. I mean, very few businesses in Australia have done that in Australia, and B, been able to replicate that into overseas markets. So look, the future is very bright for this business. We see no issues with it. And if we are right, and we do think that the Australian dollar might come off with commodity prices coming down further and mining investment coming off, then this business earns a significant part of its earnings in US dollars. So that would be a huge benefit if the Aussie dollar comes off. We're not, of course, currency traders, but we see very little reason for the Australian dollar to go up from here, more reason for it to come down. We love the business, we own it, we have not sold at current levels, and we'll continue to hold.
What I find fascinating about this business is that blood plasma and IVIG, healthcare budgets are pretty tight all around the world, and yet this is an area that's growing because of the number of things that it can help in the treatment of. So they're finding more and more uses for it, which is incredible.
But and the benefit of that is the products are so high margin. So this business just throws out so much cash. And when you've got a business like this that's generating so much cash flow, there's a few things they can do with it. They can obviously pay down debt. This business has no debt. They can reinvest that into new growth areas, and they are doing that. They can make acquisitions, and they tried to make, I think, Telecrest a couple of years ago, which of course they raised capital for. It fell over, and they used the money instead to buy back their shares at a lower price. So when you've got so much cash flow, I think it's wise, if the management think that the shares are cheap, to reinvest that and buy back the shares. It creates more value for us as shareholders in the long term.
So let's go to our next caller. We've got Bob from New South Wales on the line. Bob, welcome. What's your question tonight?
Good evening, Julia. Thanks for taking my call.
Welcome.
My question is probably directed to Russell. I know he's mentioned this stock on the program before. SIV, Silver Chef.
Doing very well.
Great looking chart. I just thought it might be a bit toppy, and would it be advisable to take some money off the table, or is there a little bit more to run?
It's a great question. Silver Chef, hitting highs. Stock chart looks good. Are you still in it? Would you be taking some profit?
We're still in it, and we haven't taken any profit in the position. It's actually one I think I've mentioned 2 or 3 times on the show. So if you followed this one, congratulations, you've done very well. It's superseded even my expectations in terms of the quickness in the markets. Re-rated it, but as soon as they did that corporate bond, I think they gave them a lot of coverage in the institutional market, and a lot of brokers have picked it up, and they've really run with the story. And you can see what's happened with the share price once institutions get behind it. Saying that, I do think it is approaching more than a fair valuation up here. But we have a very fact-based, rule-based way of selling positions in our fund, and it hasn't triggered those yet.
So how do you decide on when you're going to sell?
We have certain points in our investment process which say, okay, well, we'll exit half of our position now, and we'll exit half of our position when another trigger is met. So there's two main rules. I won't disclose those on air because we'll obviously be creating competition for ourselves. But we have two main rules where we'll exit 50% of our position, and then another rule we will exit 100% of our position. And none of those have been triggered yet. Look, this business is growing very, very strongly. It's been our way of getting exposure to credit growth. So we spoke before about ANZ having no growth in top-line revenue. These businesses that have been operating in niche markets, you got Money3, you've got Cash Converters, you've got Silver Chef, obviously, that we're talking about right now. These businesses have really taken over where banks have withdrawn from, and they've done very, very well because of that.
It's time to start the stock watch, and this time, Russell, what are you watching? Your time starts now.
Okay, so Montgomery Investment Management, we hold a large position in Resmed. The share code is RMD. It's a business that helps millions of people all around the world sleep better at night. We think that the market continues to underestimate the move of their manufacturing to Singapore and the benefits that are accruing from that. Just take their latest sales figures growth of 10% and compare that to earnings per share growth of 31%. This, coupled with a large addressable market, sets up the future for Resmed, and it's very bright indeed. So if you're not in a hurry, we think it's one to watch.